Hello, and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Trever Acers, and we're going to talk all things mid-market. Yeah, you do mid-market valuations. I think you said $20 million to $200 million. We're going to take some of that stuff that your knowledge, your multiple years, 20-something plus years in experience in this, and we're going to bring that down to our level and talk about it in a way that the merger and acquisitions guys out there listening, we know what we're going to sell to and how we're going to do our projects and present this when we go to sell it, right? This is our end goal. Our end goal is to come contact a guy like you. So that's the goal. The goal is we're going to build companies, we're going to buy companies, and one day we're going to need to call Trever and say, hey, man, I need to put this on the market. It is mid-market and it's ready to go. So thank you for being here. And let's just start with the origin stuff. So
So part of the objective, investment banking and valuation, we've been around for 15 years. So within our group, we essentially have two parts of our firm. One of the groups that I'm in is an investment banking group, and we represent sellers who are business owners who are going through the process of selling their business. And then we have a valuation practice that does very simply business valuation, and then they do a lot of exit prep, which is pretty interesting as well. I started my career in strategy consulting, went from there to tech, from tech to private equity, and then from private equity into investment banking. Been doing it for a long time.
It's interesting. I've only got to see a couple deals in that mid-market level, and it's a different ballgame. There's whole room, like data rooms. They have essentially a Dropbox folder with everything you could ever want is already in there. I would say the deals are well, way better groomed, I guess is the word I'm looking for. Everything's put together. If you ask for something, it's usually that's on page 6 of this, or it's not like give us 3 weeks and we'll create it, or give us 2 days and we'll come up with that. It's usually put together well. So I guess that's part of when you say exit prepping, it's building that data room, collecting all that data, making sure it's legible and understandable.
Yeah, it's interesting. We've think as an investment bank that the things that sort of differentiate us as we help these business owners and call it 20 to 250 million of value. Really, the things that differentiate us we end up being very very strategy driven in the way that
Hmm.
we take a company to market. But the other piece of it that's interesting is our business and our practice is tailored to business owners, right? Of this size company. And when you're call it 20 to 75 million, you may not be as quote unquote buttoned up to start with as a billion-dollar company might be. So you really have to have a process and a team that understands how to work with you, how to get the monthly financials into an adjusted EBITDA format that we can go and justify what that is to an acquirer and really get that value. So yeah, we spend a lot of time with these types of companies. The other thing I would share with you is it's interesting to see how many of the strategies that we use. We do some things that are relatively different than most investment banks. Many of the strategies we use are incredibly applicable to a company at 10 million or 20. It's not a situation where, hey, this only applies to that $100 million company. A lot of these things that the best entrepreneurs are learning and starting to implement in their sales process, which oddly enough are pretty logical, pretty straightforward. But
Hmm.
these are the strategies that are applicable to businesses of most size.
Now, do you guys specialize in like a lot of investment bankers in mid-market, they specialize in certain industries and certain markets. Do you guys specialize in anything like any industry or market?
Yeah, we have six industry groups. So we spend this day in investment banking. You really need to know the industry segment, both in terms of how to describe the company properly to acquirers, how to really know what the value drivers are, how to know who the best acquirers are in that space are. So that industry experience is something that's critical. We have 6 industry practices, everything from tech, manufacturing, consumer, then a 3 business services practice, pharma services, business services, and healthcare. And it's a lot of fun. It's a lot of fun to watch people who are except I've been one of my colleagues has been in manufacturing for 25 years. You start talking to him about how something is made, and he is just this incredibly deep level of expertise, and then that translates when he's able to characterize to buyers what's so special about his client.
And you build a trust in the industry that people know that if your manufacturing guy takes a manufacturer to and put it on the market, when you reach out, 'cause it's a little different. Business brokers in the 0 to, 10 million often make a listing, stick it on buy, biz, sell, and hope somebody comes, and it's sad that that really truly happens, but it happens often. The investment banking world, as far as I know, you actively seek out logical and strategic. These people should acquire these, and you reach out and you already have your databases of who buys what and why, but you do a lot of research into this would be great for the big guys or Coca-Cola or this PE firm is buying this. They're in that pool. And those guys have trust in you because you have built that expertise in those different markets.
Yeah,
They know that you're going to have your act together when it comes to manufacturing or healthcare services.
yeah, it's interesting because the investment banker 25 years ago used to say, "Well, I know the buyers, and so that's
Mhm.
my value proposition." And I tell you, I think that's pretty deteriorated. And the reason is everybody has Google and LinkedIn, right? Our
Right.
clients are smart CEOs, so they can talk. They know who many of their buyers are. So the key is not necessarily having exclusive knowledge about who their buyers are, but understanding, boy, with this type of strategic buyer, this is what they're trying to achieve. I've been watching them for the last 10 years. Here's their behavioral characteristics. And by the way, here's why there's such a strong fit with your company and this acquirer, or here's something we really should be concerned. I've seen this 3 times in prior deals with them. Let's watch this aspect and tailor our process around it. So it's that sort of next level intelligence where you can really add value. Because ultimately, the only reason people hire investment banks is they can get more money, increase the probability of getting a deal done, and make it and facilitate the process, that labor component. And so that's the key to that intelligence. You got to be able to increase purchase price.
From the buyer's perspective, being a small business buyer, it sounds horrific to me that it's gonna be a bidding process. There's gonna be 40 other people eyeballs looking at this. Like, I used to be in the real estate business, and I didn't go to the big tax auctions and stuff because there were 300 people in the room, and I didn't wanna be the highest bidder. Because if I'm the highest bidder out of 300 people, I probably overpaid. So that's one of those, but I get it in the realm that these are extremely sophisticated buyers. They know what their range is and they're playing for the long haul, right? That's why you can do what you're doing. It's why it appeals to them, and they're willing to be the highest buyer or highest bidder, it's why
Yeah,
it works.
yeah, and there's been this sort of revolution that's occurred in M and
Mhm.
A, and M&A has become a normalized business activity. 20 years ago, it was a strange, weird, odd thing that happened that we kind of heard about, but was very much in the shadows. It is a normal business activity today, and that has caused some real opportunities and some challenges. And as we think about it as business owners, I happen to own some businesses as well. We really think about how these conversations, how the fact that now M&A is so common impact us. And one of the factors is we've seen an incredible increase in the outreach of buyers calling on business owners. They're getting calls or emails or letters every day now.
Mm.
And there's some strategies we could talk about how we think that impacts it. But one of the things that we're seeing is it used to be I hire an investment banker to go run a market process. I want them to go talk to the 150 buyers within the world who might be great fit buyers. More and more, we're seeing what we call acquirer catalyzed deals. It's really interesting where we get a call from a potential client who says, "Boy, Microsoft just called me and I've been partnering with them for a number of years and they want to buy me. What do I do? Do I just talk to them, see if they'll pay us a premium? Do I talk with them and a couple others? Or do I go run a full market process? Or do I disqualify them and tell them to go away completely?" And so that's the decision making. And it's really interesting. It used to be that investment bankers only really ran that market process. And now there's so much more intelligence that we can help business owners with because they're getting hit on earlier and earlier.
Even in our and I would always lean towards getting representation, get an expert on your side because I absolutely promise you, Microsoft has experts on their side. They have mergers and acquisitions experts helping them do what they're doing, and if you're not I don't care if you're $20,000,000 or $200,000,000, if you're not in the M&A game, you probably don't have staff in there that's what they do and they're trained on, unless you've been in that game, unless you've been acquiring other businesses or planning for this for a while.
Yeah, and as you say, like that buyer's smart, right? So they're
Yep.
looking for a good deal. That's what they're never going to put their best foot forward first. They want to see they want to get that good deal. And this massive increase in buyer outreach for me brings highlights the thing we're passionate about. And here's the stat that sort of drives me is that I've seen this in a number of different third party surveys, but they basically say greater than 80% of business owners surveyed 2 years after the sale of their business report back that they feel like they failed in at least one material part of their deal. And when I saw the data and the different responses, I have in the different stories, it's not one thing. You think it would all be about price. Some certainly it's about price. Boy, I didn't sell enough, or but it's also things like I sold it in a structure. I took an earn out that never got earned, or I took a note that never got paid. But you also hear these qualitative aspects of where they fired all my employees. They didn't take care of my clients. They moved my operations to wherever. These are the things that impact folks. So if we're when we're talking to these business owners and you're saying, why are you feeling like vast majority of them are feeling like they failed, it's because they followed the default process because they got the offer and thought about it and maybe they ran a default process, but that default process is going to get default results, right? They're going to be in that 80% or they get lucky. So one of the things that we really that's the thing that keeps me up at night, right? When I get up Monday morning and you're trying to find that reason why you're going to go work hard and fight for somebody, it's because of that potential for failure for people who have put their everything into their business. And so we see a number of strategies, things that you can do different than everybody else that significantly impact that ensure you can be part of that 20%. And it's really comes back to the root cause. The root cause of that failure for most of those people, they did not know what they wanted when they went into it. Had they known what they went into it, they would have designed their process around that objective and been much more successful.
If they grew that thing from scratch and they started from 0 and they're now working with investment bankers, they still have that mom and pop mentality of looking for a safe pair of hands. You see and hear that a lot in the small business community where a lot of times the top bid doesn't win. It's the safest pair of hands, the safest like, hey, they're going to take care of my employees. They're going to take care of my brand. It's going to stay in my small town and provide jobs for my neighbors. Is as important often as the price tag. When you start getting big and private equity starts playing in, I always say, if you know what the phrase cap table means, you probably are going to have to sell for the highest and best price because now you got too many shareholders that one of them's going to hold out for price, right? Like in our small business world, I always tell people if it's got more than two partners, I probably don't even want to chat with them because in the small world, getting two people to align without a team of attorneys and everything else is tough enough. You start getting third,
Yeah.
fourth, and fifth, it's all becomes down to somebody's going to be stuck on it's just a numbers game, right?
Yeah, and one of the big differentiators when we start talking about private equity has moved down, right? They used to start at 4 million of EBITDA minimum, and now they're sort of at 2 million. You see a bunch of private equity firms that are sub 2 million of EBITDA. So I think one of those things that you're looking at from that qualitative perspective is who's the right partner. Not only
Right.
who's likely to close the deal, but who, if I'm going to roll, which often you're rolling equity into the new deal with private equity, that's one of their often common requirements. Who am I in with? Who, when we have a bad day, who's going to be my partner versus my detractor? Who's going to help us scale to our full potential? There is a certain selection bias there as opposed to this perception that somehow private equity is all commodities.
You think that's due to them dipping lower and lower? I think it's due to competitiveness, right? 5 years ago, they could buy up, quite a few mom and pop heat and air plumbing companies at 4,000,000 in EBITDA and above. Now, every PE firm's kinda dipping into that space, home services. So if they want to get some action, if they want to be a little, not in a bidding war with another PE firm down the street, they kinda have to go, "Okay, I'm looking for that fast-growing $2,000,000 one. Okay,
Yep.
now that space is getting crowded. Now I'm looking for that 1,500,000 will be 2,000,000 by the, end of, in 18 months or less." So,
Yep.
it's necessity more than anything that's making them go smaller, I think. Is that what your opinion?
Yeah, you also see that's exactly the reason they're going smaller. Plus, they're chasing that opportunity.
Mhm.
The other thing that you see is their expansion in terms of industry interest.
Yeah.
Historically, private equity was looking for that manufacturer, right? That widget maker, because that was their model. They understood how to do that. We see private equity very active in spaces previously that they wanted nothing to do with. So, for example, if you look at corporate event services, or business services group spends a lot of time in this space, that can be cyclical based on corporate profitability. It's a certainly an asset light business,
Mhm.
but we see private equity heavily involved in that space, and it's not because they suddenly fell in love with it. It's because it's a competitive pressure. It pushes them to become experts in spaces so that they can find good deals.
I think part of it in the home services is anytime you see the economy getting a little rough, you start looking like where's the safe place to park money. If you live in the like I moved to here in California, we don't need a heat and air. We need heat in the winter, but we rarely need our air conditioner in the summer because it's a nice mild temperature where I live. But in Oklahoma, I'm telling you, where we moved from, it gets 110 with humidity during like the worst couple days of the summer, and it stays 101 at night sometimes. You're going to have an AC, right? So whether it's overpriced in the market or not, the AC is getting fixed.
Right,
The heat
right.
and air is getting fixed. So uh, I think a lot of it has to do with I think the economy is still in that uncertainty stage. I don't know if we're a depression, recession, it's recovering or whatever, but so long as it stays uncertain, people looking the PE firms are smart money. If you watch what they're doing, it's smart money. They're looking for things like what's going to be okay if it goes worse. Your heat, your air, your plumbing, your home services, your pest control, those type of things. The reason they're getting rolled up and bought up is mama's going to get the rats and the roaches out of the house, whether whether the economy's good or bad, right? But I think a lot of it has to do with the reason in the last 4 or 5 years you see a lot of them coming into the home services and stuff like that is it's kind of a economy agnostic. It's gonna do good in good economies, it's gonna do okay in bad economies, and they're gonna move forward.
Yeah, no, that's absolutely that perception of risk. Of boy, we think that there is a cash flow that is going to continue no matter what the economic outcome is. That's why fundamentally why private equity is willing to pay so much for subscription software. Is they
Oh,
look at
yeah.
that reoccurrence rate and it's incredibly attractive. That means low risk. That means I can spend a lot.
How do you think the economy right now, like in the small to medium business, the interest rates shooting up kinda stagnated everything, and I hear now that it's starting to pick back up because it's normalized. People are acclimated to it. I think it's the real reason. They're like, "This isn't going away," so they basically just gotta figure out, "How do I work with this?" They're coming up with solutions and making things work. Did the mid-market have that same slowdown when the interest rates shot up? A lot of these guys raise capital different ways, so
Certainly we saw a slowdown in 2023 of
Mhm,
just M&A volume. And when we talk about the middle market, it all really depends on both your industry segments, which were pretty wide, but also your value range of that 20
mm,
to call it 250 million. We see a lot of 20 to 100 million in that space. We saw a slowdown in 2023, but the it was amazing to see how aggressive out of the gates private equity came at the start of the year because they make money by putting money to work. They did a reduced number of transactions. They needed to get acquisitions done, especially add-on acquisitions that represent a little bit lower risk. And
mhm.
we've seen a tremendous increase in the last couple months here from basically sellers calling us. Boy, I keep getting called by private equity. I think I want to explore one of these, and that's private equity driving that outreach. And they've been very aggressive.
I get that, and part of that is they have, time commitments on the money that's pledged to them, right? So if you go out and do
Yeah,
a private placement memorandum and the securities filing and everything you need to do, and you do your raise, you go out and raise your 100,000,000, 200,000,000. I've interviewed people in the last 2 or 3 weeks that have done 225 million dollar raises for buying small to medium businesses, and they have a time commitment too. There's a window in which they need to deploy the money and get it to work, right?
Yeah, yeah,
So
and that I will tell you that private equity backed, we call it private equity backed strategic. So a company that's been acquired by private equity that's now going to make on these smaller add-on acquisitions. This they are possibly the best buyer in the space often. And the rationale is they have both the synergies that they're going to achieve through
mhm,
the I'm going to sell to your customer, you're going to sell to my customer type of post acquisition economic synergies, but they also have the mandate. I need to go out and buy. I must go buy in order to create value. And the combination of the synergies and the mandate plus the cash to do it really
mhm,
makes them very, very dynamic buyers. And it's interesting that this is where some of those sort of different strategies apply. One of the things that we often get this call from a client. Wait, just got called, private equity firm. They have a portfolio company in the space, and the default process leads these business owners to a not so great outcome. Basically, the context is they need to change the frame. So the frame is, hey, tell us about your revenue, send us your financials, tell us about your revenue and your EBITDA. Private equity and strategic buyers as well, but they're very, very focused on EBITDA, right? And the
mhm.
multiple, and they're looking at that valuation as a multiple of EBITDA, which is a very appropriate from a market perspective way to look at it. But we're often encouraging business owners who are getting these calls, especially from private equity backed strategics, of spend a little time trying to change the frame. If you think there's a great fit here, then instead of just solely talking about your EBITDA and sharing your financials, start a collaborative and partner like conversation about how much money you're going to make in the next 3 to 5 years together. Because when you do that, you're helping them understand, is this actionable? Is this very attractive? How much money am I going to make? But it starts to reframe for for that acquirer, how much am I willing to pay? And it starts to, hopefully, if done right, and you really get into the details, you quantify what those synergies look like, you then validate them, make sure they're real together. And what allows that buyer to do is justify paying a premium for the company because the logically it makes sense. Yes, I understand that your market, for example, might be 5 to 7 times earnings, but I'm willing to pay you 8.5 because A, you're in a competitive situation, and B, you've shown me that it's still a great deal for my shareholders. We recently had a client. They were at 4 million of EBITDA. They were going to get an offer at about 7 times, so about $28 million of value. And we spent time. We leaned in with that high fit acquirer and found that they had about $3 million of synergies that they were going to achieve very, very quickly with a high degree of certainty when they made this acquisition. Which means then for that acquirer, we're essentially we our client represents about $7 million of incremental EBITDA in a relatively short period of time. And if that buyer was, in this case, they were valued at about 10 times earnings, that means that, do the math, that means that we're creating about $70 million of shareholder value by completing that transaction. So that's the logical justification to the acquirer why they can justify paying more than 7 times. Boy, you're going to pay me 28 million, I'm making you 70. So what if you pay me 35? Does that still make sense? And so that in some competitive pressure really create logical justification for that acquirer to pay that super premium.
I don't feel that that translates all the way down to the small side. So anything below that 2 to $4 million range, we really, all the buyers I talk to, myself included, we try to separate the performa, the future, right, from the past. Like we base, okay, the business is worth what it's doing now and some expectation of growth, but not like what am I going to make in the next 2 to 3 years? Because that's a lot of sellers, especially ones that are unrepresented by brokers. They're gonna go, "If you do X, Y, and Z, you'll be making 10 times more money." And I was like, "Okay, why didn't you do it?" Like, the real question is
Yeah, right, right. Projections are worth the paper they're printed on. Yeah, I think
right
the synergies, and this is where it does apply to the smaller companies. Is if this big company comes to you and says, "Hey, I want to buy you," and I say, "Look, I'm a small company, and what I want to do is say, boy, if you had my products, or if you had my service, you could sell it to all your customers.
mhm.
And if I had your products and services, I can sell them to all my customers. And so now we can start look at each of those synergies and that incremental profit contribution, and I might say, boy, I think you can sell my product to 70% of your customers in the first year. And you say, Trevor, 70%, maybe 40%. Okay. Well, that's 40. Let's say 40%. So now I'm selling my X $100 product to those 40% of your customers. That's going to kick off a bunch of revenue, and that's going to kick off a bunch of incremental EBITDA just by putting that extra product in your sales team's bag. And so that's as opposed to, hey, I'm going to grow over the moon. Growing over the moon is hard. That's a hard projection. And that means earnout. That means that we're going to have a gap here in perspective. But when I start telling you as a buyer uniquely, giving you insights into how much money you're going to make because of these synergies, and then we vet them together. Because oddly enough, that's the insights the acquirer wants as well. They want to know, boy, if my sales team had this product, they would sell it at this price point, at this gross margin. We would be able to apply it to at least X% of clients within the first year, and this how much the second year. And now I've got a business plan. I can go back to my board and say, I know the guy wants a little bit more than normal, but here's why we have to do this deal.
And then on the non-software side, when you start talking about manufactured goods or products, the buying power drives that like, if I'm selling 100,000 units at one thing, I'm paying a certain amount for my raw materials. I got more negotiating power once I can go, okay, we're going to triple sales this year and I'm buying 3 times as much material. You go back to the same suppliers and go, hey, we're getting acquired by so and so manufacturing. They're going to sell to all their customers. We're going to need 3 times the raw material. Can you provide that to us and at what rate? And if they say the same rate, you're like, no, I'm going to put this for a competitive bid now because now I don't need 10,000 pounds of your raw material a year. I need
Right?
100,000. And first of all, you need to show me that you can do it. And second of all, I think I can get a better price at, at 100,000 units of that particular product. So there's all kinds of sides of this. When you look at increasing sales, you can also increase efficiencies, right? The production costs and cost of goods sold
Yeah,
go down.
I think that's a
Yeah.
great one, right? Like input costs, right? As we have buying power, how that changes. We were just talking to a client today, and there we looked at it and basically said, "Hey, Mister Acquirer, all this cost below the line, below our gross profit. Think about the other synergies. So, for example, warehouse
Mm.
consolidation. So now instead of that warehouse cost that my client has to incur on a daily basis, they're just going to have the incremental cost of having a little bit more space in their huge palatial existing infrastructure. So what we often do is identify each of those synergies, and we literally walk through and how much incremental profit does that create, and I want to add all those up, A plus synergy B plus synergy C, and look at the incremental profit contribution that my deal represents. And then I multiply that by what's the multiple of EBITDA that the buyer is currently trading at. So maybe it's a public company and it's 15 times, and I'm creating 10 million of incremental value because of all these synergies. It's $150 million of shareholder value that I represent. Now they're not going to pay 150, but they can logically now justify to their board or whoever else there is that, boy, that acquisition at a premium, we don't love it, but it makes sense, and we're going to do it.
So we talked about saving money and stuff. There's actually an opportunity cost and an expense to vetting the whole process. If you're a business owner, especially in the small business and our SBA, Small Business Administration loan side, when that owner decides to sell, now he's got to put on a new hat and actually prep it and do all the standard operating procedure. Everything is going to do. He's got more work to do than he did before to move himself out of the way. There has to be some of that too. There's got to be a cost associated, even if it's just opportunity cost for having your executive team go through the M&A process, and it may or may not make it to the end.
And it's possibly those things that you feel passionate about. This is one of the ones that I feel incredibly passionate about. We spend a lot of time educating CEO
Mhm.
groups about this issue. Is that you can lose millions of dollars going through a sale process that doesn't complete, and it's not the cost of the advisor or the legal team or the accountants. The cost is the fact that if as you have your management team start to focus on a M&A, selling the business, an M&A process, it sucks time and focus. And so just give you an
Yep.
example. If you're calling it, you were supposed to do $4 million of earnings this year, and instead you're going to do 3.5 million because your management team got so distracted because when Microsoft calls or whoever it is, Walmart called, suddenly you decided to get very, very involved in this conversation. You can look at that $500,000 of EBITDA that you didn't get. Let's say you're valued at seven times earnings. So now you're talking about $3.5 million of lost enterprise value. That's a hell of a lot of money. So
It is.
that's what we're playing for as we think about, as business owners, how we make a good choice. And the key is, we call it aggressive disqualification. Boy, who do I talk to? When do I talk to them? And what do I share? And that our perception is that there's tons of outreach going on. So the first thing you need to know is what we call your number, right? I need to know, if I'm going to sell today, what number must I get in order to justify the sale of this cash engine that I'm building? And that's we start with typically pre-tax. We start with after tax, and then we build up. We build that up into pre-tax, so we can tell the acquirer when they call what that number is as part of our strategy. We can use that to aggressively disqualify. The next thing I ask is, like, who do I talk to? Well, if I'm early in my building process, no one's going to pay me what I want. So I'm not talking to anybody. I am just keeping heads down. When I start getting a little bit further through that growth curve, I'm going to start having select conversations with the highest fit acquirers in my space. Maybe the private equity firms that have a portfolio company in my space who I think are a great fit. I'll start having those conversations. I may or may not be interested in actually taking a little bit further, but I at least want to establish the relationships. And then when I get to a point where I can kind of see exit from here, I'm not there yet, but I can see it from here. That's when we start recommending using this aggressive disqualification approach of basically saying, "Hey, I'm executing a growth plan. I'm not done with it yet. I get a lot of interest, but this fit is really interesting. You are such a great strategic buyer. So I'm open to preempting my process. But if I were going to do that, I would need at least X million dollars in order to sell this." And what I'm trying to do is create a floor, not a ceiling. I'm trying to help them understand that this is the buy now price that they have to be willing to pay, often a premium, in order to justify that sale. And I want them to go away. I want them to say,
Mhm.
"Oh, no, no, no. We can't. Thank you so much. We can't pay that at this time." Great. So I can keep back focused on my growth. Or the alternative is true, where they say, "You know what? I know that's a premium, but we're open." And now I've created a situation where I can take that next incremental step with them, and I can justify spending a little bit more time. I want to avoid the scenario where I blindly take the call, jump in 6 months later. We talk about price, they're 2x off where I need to be. And I've spent millions of dollars of my shareholder value on that mistake.
There's a lot of power to being open with some of those key strategics too, in that in our small to medium business world, I've interviewed a couple guys where they just off camera, they said, "Hey, I said the fastest way I really sold this, and I can't really say it, is I told my one of my strategic partners, one of my kind of not competitor, but somebody we upsold and shared referrals with, like if they couldn't handle a client, they were too big, then they would up and they would, basically pass the you probably should call X, Y, and Z." In those conversations, like, when they would talk about the companies, I made it regular conversation that our intention was to grow this to some point where we sell it to you or one of your competitors. So they put that bug in the ear, and the conversation is brief during that. It's like, "Hey, well, if you were to sell us, what were you looking for?" Well, we're trying, and they had a number in mind. We're trying to get to at least a $12 million, $15 million exit, and, you know, what would it take? And then there's a short conversation. What would it take for you to acquire us at that? Well, you need to be at this number. So now they both got goals to work on, and they know, you know, and it's funny that they're it's often groomed. I mean, you'll groom that business for not just one, but if you're smart, you're doing it for two or three in case the guy says no. But you kind of know what the industry wants, what they expect out of you, and that's what if you're really building something to sell, you're building it towards the need of the upper market, the market that's just above you or just a couple steps above you that would be your typical acquirer.
Yeah, that's a very common strategy for us to talk with a couple of the highest fit acquirers, establish a relationship. Humans are really interesting. Not only does it put them on their radar, so their M&A team is watching you, but humans perceive that if they perceive there's less risk there if they're familiar with you. And by less risk, that means they're willing to pay more. So it really
Yep.
sets you up for, they may or may not be willing to buy at a super premium today, but 3 to 4 years from now, when you're ready, they know your name, they know who you are, they've been watching you, they're so excited, and they're much more willing to pay a premium price as opposed to just approaching them.
So private equity, in my mind, has something really well going with it, and I know a lot of people who have sold to private equity. I've interviewed a lot of people who work for private equity, and one of the things they have is they have a solid deal team. So if they acquire so and so software company and they're going to build on it, they're not distracting that general manager, the new CEO, or the person responsible in the early stages of other deals. They have an in-house deal team that's going to go out, vet these things, look at the corporate culture, look at the numbers, and it's not until the final realm of hey, we're really serious about this that there's any distraction. And I think the brilliance in that is there's an opportunity cost when you start getting distracted by all these other tasks to do when you're trying to run a company, where your innovation kind of dies down and some of the other stuff that happens that would normally help you grow because you're looking at, oh, I don't have to grow 30% this year because if we acquire
Right.
this, I double in size, right? Your back's not against the wall anymore to where you feel like your back's against the wall if you don't have these strategies in place.
Well, and I think what we're seeing is business owners are getting called on earlier and earlier in their growth cycle. Where we have
Hmm.
a client we're advising today, and they're saying, "Look, we're like 5 years out from where we thought we'd be talking about this." But one of the biggest strategic acquirers came by, and what do we do? How do what do we share with them? How do we navigate this? And that's the strategy we said, right? Let's establish a relationship. Let's try to let's disqualify them. That means we're either going to be friends today, we're going to be business partners today, and looking for opportunities to partner, or they're going to acquire us, or they're going to acquire us in 3 years.
Yeah.
And that's the kind of we call a string of options that we want to have in front of us. And the fact that they're each of these all these companies have a private equity firm essentially supporting them makes them really easy to work with. It's great to have professionals on the other side as long as we don't just follow their request for data. Because if not careful, what happens is they just keep asking for more and more and more and more and more data. And next thing you know, we've told our direct competitor everything about our pricing. So we
Yeah.
need to be able to try to qualify or disqualify them way before we start sharing too much information and get too distracted.
If you're playing the long-term game, wouldn't it be smart to do kind of, channel partnerships or something like that to where, like, "Look, I'll sell your stuff to my customers. You go ahead and sell my stuff to your customers. Here's our price point. We'll become channel partners," or whatever. I don't know if I'm using the right phrase there, but you make the strategic alignment inside of there early. You start making the sales. You get the more revenue because they're selling your product. You get a new item to offer your customers. So both companies are making more money, and you some of that stuff early on. If you're gonna play the 3, 5 year game and, and you're still not married if to that person to be the buyer.
Yeah, it's a classically good strategy for that reason. In that, in the short term, it drives revenue and it helps support our growth. They
Mhm,
may not be our forever person, right? But today, it's a great partnership in supporting where we're trying to go. And then it's
mhm.
amazing how many acquisitions come out of partnerships. Boy, we've been working with them for 5 years. This story is what we hear all the time. We're working with this company for 7 years. They're a great fit. They're such a nice partner. Now they want to buy us. Well, why do they want to buy you? Because they want to take our tech and do something slightly different with it. They want to take our product and create exclusivity in this market. They want to do, there's this comfort and familiarity that gets created by being a partner that is an incredible catalyst for M&A.
I've seen this in the VC realm. So I come from tech. When I got out of the military, I went to work in the defense contracting space, and all my buddies were making millions in the tech space. So I jumped in there just in time to watch it blow up. But I got to see some really cool things inside of that. And one of those things that I got to see is just like we're talking about companies being groomed to be purchased over time. I won't say any business names because I don't know if this is totally okay, but I know of at least 2 or 3 of these venture capital backed startups where the company that ended up acquiring them was one of their key investors, early in round 2 or 3. At some point, like one of the ones I work for, they were a key investor. They ended up on the board, and then when our CEO left, they one of their general managers came over, quit his job, and became our CEO. And then a year later, we were bought by that company, and that general manager from the other company became the CEO of the big dog, the big company. And, I don't wanna call that out, but I've seen it twice where it was kinda groomed to when they invested in it, they really were they had inside eyes into it, and then they ended up buying it.
One of the things that we see business owners as they're sitting and looking at all these options is they
Mhm.
do this. The question becomes like, so what do I do? Right? What investors do I take? let's assume that now that I'm going and I'm growing, like what do I do that's going to be able to have the greatest impact on that outcome? One of the things I've seen it's relatively new in M&A is seeing valuation groups start to do this, help give guidance on what should you do in order to make yourself more and more attractive, because historically valuation folks did compliance driven valuation, right? You're going to do a stock option plan, you need a 409A valuation, or getting divorced, you need a valuation of the business. But now they're starting to really apply some smarts, and it's cool where you're looking at saying things like, boy, they're identifying some lines of business in your business are more attractive to acquirers than others. And then, so what does that mean? We see things, for example, we see that in software, subscription revenue is dramatically more attractive than maintenance revenue. Okay, so then the question becomes back to the company of, is there any way you can take some of your maintenance services that you currently charge for and wrap them into your subscription, increase the value of your subscription, increase the price of your subscription, because you're getting paid, call it 4 to 6 times ARR, recurring revenue, for that subscription revenue, and you're getting paid 1 times for the maintenance. And they start to really work collaboratively with entrepreneurs and start to apply this intelligence. It's making a difference on a daily basis to see these guys do this. We see questions like we saw recently a change in the business model. We had a training company that was very, very hands-on, in-person training, looking at their, how do we compare the focus on that growth versus the growth of our, call it, online delivery. The online delivery was a lot less in terms of revenue. The price point was much smaller, but to acquirers it was much more scalable, much higher profit in terms of margins, and the low cost of delivery then allowed this company to get from the enterprise into SMB. So there was these, like, that's the kind of stuff that as entrepreneurs, where we're sitting there a couple years out as business owners and thinking, I think it's really neat to get minds around that. What do I do in a prioritized way? Because there's 1,000 things I can do to improve my company. What are the 3 or 4 that really add a zero to the end of that outcome?
At what stage in a business do they start looking at who's my upriver? Who are people upstream and what do they need? Because if you're thinking a lot of people just create a business and they grow it and they don't think about like, okay, someday I'm going to sell this. But at some point everybody sells, right? There's only been 4, I think I did the research once. There's like 3 or 4 companies that ever made it over, 700 years. Only 2 have ever made it over 1,500 years. One of them was a little place that built temples, in, Japan or another country, and the other one was a pub. So everything else is always either sold or shut down, right? Something's
Right.
happened. So your business is either gonna sell or dissolve some way, some shape, or whatever at some point in the future. Even that temple one, when I did the article, they were still that I read and wrote on, they were still owned, and at some point they hit financial difficulties shortly after, and they're owned by somebody else now, right? So everything sells.
Yeah, or goes away. That's exactly right.
Yeah.
And it's amazing. I mean, I think if you look at it statistically, to be able to sell your business, no matter what the outcome, to be able to sell
Mhm.
your business, what an amazing compliment, right? What a tremendous outcome. And so, like, the question that we're talking about today, they're already victors. They're already
Mm.
successful. The question is, what level of success can you get to them, and can we do some things in those last couple years, or even just in that negotiation with the buyer, that significantly increases that success?
It takes some self-awareness of the owner to go, "Okay, I've taken this horse in this race as far as I probably can take it. I'm either entering retirement or I'm hitting some plateaus. The next phase of this business is probably to be acquired by somebody else. And what does that look like, and how long do I need to prep for that?" In the small to medium business, I'll tell you, most people, they wait until it's too late. They think they can sell their business in 6 months, and they don't realize there's 3 years of work to do for prep, especially if they're doing their accounting. If mama's doing the accounting on the kitchen counter, and you'd be surprised at how many millions people make before they get a CPA. But that you wouldn't be, but a lot of people out there listening would be surprised. It takes something for that CEO to go, the writing's on the wall. I'm 67. I don't want to work here until I'm 80. what do I need to start to do to make this the most valuable for myself and the employees that are here and that built this?
Yeah, and I think the other thing that as they start having those conversations is to think about that full range of options, right? Selling the business is one of them, but are there? We always encourage clients to think about it within that full range. Is there someone in your
Mhm,
management team who could take this over? Either in terms of like the operations, maybe you continue to hold it, but you trust them enough so you don't have to be there on a daily basis, or
mhm.
maybe I sell that to them. Maybe I sell that to the team via a number of different mechanisms. But I think we're our passion is helping entrepreneurs make really good decisions, and as part of that, it's setting that context of all the options in front of them. And the only time we pursue sale is when it's like, wow, sale makes so much more sense than these other options because of all the unique factors that make us business owners, all the objectives that we have.
Yeah, I'm 52. I don't know if I'm gonna get there, but my long-term vision is to build something to where I'm big into having trust and set up to have some form of family office that owns the holding co. And the general managers are there running it, and my kids don't necessarily have to run the company. They're not spoiled rotten. They have jobs to go to if they want. But my long-term goal would be that a family office is created out of this type of actions. That's something a lot of these in your market, there's all kinds of other avenues other than selling, right? There's employee stock option, transfers where you can sell it to the employees. There's bringing in great management, setting up the right structure to have your own family office and have it just run and kind of bringing in an oversight board or something that can keep it running for the next generation. And it's not your employee. The small business owner thinks that, the guy like my father owned a painting and remodeling business, turned it to me when I was 16. So I ran it for a while. That mindset is like if my son doesn't run this, I have to shut it down is in that small game to where, if he grew it was six figures at its peak, not high six figures, but when you're talking 20 million to $250 million, you're talking now you can bring in staff, you can bring in an oversight thing, build a family office out of it. And the family office's job is to make sure that the right general managers in place, the right teams in place, and that they're hitting their KPIs and their numbers, and it runs for generations. So it doesn't necessarily always have to be an exit, right?
Yeah, no, I think it's that it's really figuring out because there is no right answer. It's really figuring out for that business owner's objectives, right? And maybe it's
Mhm.
their family's objectives. Everyone's series of objectives are unique, but for their objectives, what is that best option? And sometimes it's parallel, right? Sometimes you need to run those in parallel. Boy, we think it's a sale, or if we can't sell it for for at least X, we're going to give it to our nephew, or we're going to sell to our employees. We're going to follow an ESOP process. So it's really, I think the key is really being thoughtful about it. And then the other piece of it is not underestimating the risks. The data says that companies that are not run by professional management teams or founders tend to not do so hot over long periods of time. So there is some significant risk of the idea of, hey, I'm just going to let my some of my employees keep running it, and I'll own it and hopefully take that passive cash flow. But it's situational because we come across every once in a while a situation where it's like, boy, this will be spectacular. The best outcome for everybody's objectives is going to be having one of our team members run it, or selling it via an ESOP, or some other mechanism, or keeping it within the family.
One of the best ones and smartest ones I've seen, and I won't call out the industry or the person, but, they did what we jokingly named it, because I'm gonna say what we jokingly named it. If you search for it, they can find it on the show because he was on the show. Acquire to retire. So what he did was he had a pretty good sized company, and I think it was like between 10 and $12 million, depending on the good year or bad year, decent profit margins, and he was ready to retire. So he acquired there was a rock star company coming up in his space just outside of his market, but he knew the guy, knew it was running. It was half the size. And he reached out to him and said, "Look, I want to talk to you. I'm going to acquire. We're going to merge the company. And guess what? You're going to be the CEO. You're going to own 40% of it. I'm going to own 60% of it. And you're going to run it until you don't want to run it. And then if when you're ready to sell it, when you're ready not to be the CEO, come to me and we'll decide if we're going to bring in another guy in or we just sell it together then." And it was brilliant because now this guy was half his age. He's just doing tremendous, great marketing. He really was impressed with what the guy was doing. So he reached out and said, "Hey, I'd like to acquire you." Instead of saying, "I'd like to sell to you, I want to acquire you. And by the way, you get to be the CEO of both parties." And I thought that was a brilliant move, right? He had to sell some of his commercial real estate to do so. right. So
Yeah, so thoughtful. I mean, that's the intelligence. I think there's been a tremendous change in the opportunities for owners where
mhm.
the range of options in front of them is tremendously increased and the opportunity for them to find a liquidity exit has increased dramatically. And that's where the man then basically that calls upon the business owner to take advantage of that, to
Yeah.
take the pause in their day, the thousand things going on, and take that kind of quiet time and what do I want? Right? What are my objectives? That's the first thing they got to figure out. What do I want? What matters to me? Everyone's unique. Once they figure that out, now they can start assessing all these strategies as opposed to just blindly starting a strategy and see if it helps, see if it works. That's unfortunately the common sort of default we see is people just go down the ESOP path without kind of thinking, was that the right thing for me comparatively to the range of options that I have?
I've never told anybody. I say never. I don't think I have. I don't think I've told anybody, "No, I'm not interested," after doing 2 or 3 calls without sending a follow-up email saying, "Here's all the things you need to, here's where it went wrong." Like, I usually a 1 or 2 pager if it was printed out. Like, "Here's some bullet points. If you focused on this and you got this stuff fixed, call me. And this is what every other buyer is gonna look like." And I take the time to do that because I believe that true entrepreneurs are serial entrepreneurs. You're eventually gonna sell that company and you're gonna build something else, and when it's ready to sell, I want you to call me again, right? And even if I didn't buy the first one, if it wasn't a right fit
Right.
the first time, I wanna be the first guy you call who's gonna take a look at your next business and go, "You're almost there, do this and this," and then the next time he's close enough because he knows what I wanted, he knows what my team wants, and he'll be closer. So
Yeah.
I long-term strategic thinking when it comes to that realm is to, entrepreneurs are still entrepreneurs unless they're retirement age, they're gonna go build something else. They say they're gonna retire. You're 45, you say you're gonna retire, yeah, about 6 months from now, you're gonna get sick of golf and fishing, and you're gonna be doing something, right?
Well, we often are giving that advice to clients who or companies that may not necessarily be clients, and you'd ask, like,
Mm,
"Boy, why are you spending time giving them guidance?" And we have this philosophy of give expecting nothing thereof, which is Thomas Aquinas. And the idea is like,
mhm.
if you help people, you come from a place of love and help people each time, you might not always get something from it, but I promise you over long periods of time, it's going to work out.
I believe that 100%. I'm on board with there, and I think the second thing, and it's so critical in the small space, rapport wins over everything else. Business owners in the small space, that 5 million, $10 million and below, will sell at a lesser value to somebody they know, like, trust, and built rapport with than they will hands down somebody who they just don't get along with. And I think it happens all the time, even in the mid-market space too. You can't go around a little less because you got investors involved in numbers, and it's a little bit more of a numbers game, but there's still some element of building rapport and trusting people.
And I think that calls on buyers and sellers, but to
Mm,
be good citizens, right? To be good partners through that process. We have a client who just walked away after 4 months with a strategic acquirer. We just walked away from the deal, $80 million deal. Our client would have had more money than he ever thought in his life, but we walked away because he could not look himself in the mirror knowing that his brand and the quality that he brought was going to be taken over by people he felt were jerks. And so we walked and we felt really good about it because he's going to look back 2 years from now and say, you know what? That was a great decision. And I'll go out and get that plus some in the next market process for him. But I loved that decision because otherwise he would have looked himself in the mirror 2 years from now and he would have, it doesn't matter how much money he had in the bank. He would have been heartbroken.
and so it's good to hear it still happens at that mid and upper market. I just knew it did, but to know that you have live examples where people like, "Look, you're not the right fit. But yeah, you got the right wallet, right? Yeah, your wire transfer looks really appealing, but everything else about you just rubs me wrong."
Yeah, and they're not fools, right? They're not doing it
Right.
because they're like sentimental fools. They're doing it because they didn't want to go spend 4 years of their life working for those people who they didn't respect. They didn't want that perception, and they knew that they could probably get an exceptional price from somebody else. And
Mhm.
so there was good logical justification, but understanding both that quantitative objectives and that qualitative, man, when you know what you want, so much more of a higher probability of achieving it.
Awesome. Well, one more time for everybody listening out there, what is your target market? So that if somebody's listening now and they're building a company and they're going to sell and they want Trevor to be take a look at their business. What is that what do they need to grow to? What do they need to prep themselves, to before you start working hand in hand with them?
Yeah, so we're working with companies 20 to 250 million in value within our sort of six industry practices, being at tech, where we have a ton of SaaS experience, manufacturing, consumer, where we do a ton of apparel, specialty food, recreational products, our pharma services, where we do a ton of marketing companies, oddly enough, in the sort of pharma
Mhm,
space, business services, healthcare services. Those are the spaces, but it's really that 20 to 250 million that are value. And it's either a scenario of the classic, I want to go sell my business, or the increasing popular scenario of the private equity firm that I really think is impressive just called me. What do I do now?
mhm.
Either go talk with that one and get a super premium or go run a market process. That's a
So,
great fit for us.
is there anything to do with, like, I'm at 15 million now, but I'm on trajectory to be at that $20 million within the next 24 months. I need to start talking strategy now? Is that too early to call, or
No, that's exactly the time. It's 2 to 3 years before you want to sale, where we really want to sit down and talk a little bit about strategy. We want to run what we call sale proceeds analysis. What's our valuation today? Where do we want to get to? And then the other thing they can do is work with our valuation team doing a gap analysis of here's if this is our valuation today, what are the things that we can do in our business that impact that valuation the greatest? I mean, that's where you, in a perfect world, you want to start 2 to 3 years before because you can make a difference in their outcome at that point in time. You have more levers to pull. They can do more to help themselves.
awesome. And then how do you want people to reach out to you? What's the best way for somebody to contact you?
Sure. Take a look at our website, objectiveibv.com. My email, trevor.acres at objectiveibv.com. We have a team, a very, very collaborative team approach is the sort of culture we've created within our organization. So any one of our senior team members has got deep industry experience and is going to do an exceptional job of guiding you through your full range of options.
And for purposes of our short takes, give us 2 to 3 things that, like, if people somebody can only remember 1 or 2 things, maybe 3 things from the day's conversation. What would you want them to walk away with?
Sure. I want them to change the frame of the value of how they value their business or change the value frame. So when buyers come to them and just ask them for financials, I want them to supplement that conversation with let's talk about our synergies. Let's identify them, let's quantify them, let's validate them. That changes the value perspective of are you going to just pay a multiple of EBITDA or are you going to pay me a portion of the value that you're going to get as an acquirer? The second thing I would do is really encourage them to aggressively disqualify all of the incoming options. Either we're heads down, we're being very selective, or we're being slightly more open, but we're very, very thoughtful about spending time with acquirers because they can suck millions of dollars from us.
Awesome, cool. Well, we'll call that a show, and, we'll wrap this up, and thank you very much.
Yeah, I really enjoyed this. Thanks so much for the
Cool.
opportunity.
Hang out for just a second. I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.